Okay, let's unpack this. Welcome to the deep dive. Today, we're cutting through the complexity of the RTX third quarter 2025 earnings conference call.
Yeah, we're looking beyond just the numbers.
We want to find the central drama, really, playing out in one of the world's most critical aerospace and defense giants.
Exactly. We've synthesized everything,
Yeah,
the earnings call transcript itself, the investor presentation slides, and that press release from October 21st.
right.
Our mission is basically to distill the key performance indicators
Yeah,
and the updated financial forecasts.
yeah.
But maybe more importantly, to define the core strategic tension of the quarter.
And what is that tension? I mean, the headline nugget sounds phenomenal, right? The company called Q3 very strong, driven by intense execution and crucially durable global demand. They even raised their full-year outlook for both sales and EPS.
That's the good news, absolutely.
Uh-huh.
But the central tension, the thing that really defines this report, is that monumental accelerating demand hitting up against the physical limits of the global supply chain. This whole deep dive, really, it's a tug of war. You've got incredible order intake on one side,
Right.
and the struggle to actually find the parts and materials to fulfill those orders on the other.
Got it. Okay, well, let's start with the money picture then, because the consolidated Q3 numbers are, frankly, staggering. Adjusted sales hit $22.5 billion.
Yep, $22.5 billion. That's up 12% overall and 13% organically year over year.
13% organic growth. Wow.
And look, this wasn't just revenue growth. It was profitable revenue growth. Adjusted segment operating profit was up a massive 19% year over year,
19%.
which drove 70 basis points of margin expansion across the whole business.
Okay, 70 basis points. That really shows that operational pivot they talk about, the core operating system. It's not just theory anymore.
Exactly. It's visibly converting those productivity gains into actual profit. You can see it absorbing costs, even with inflation.
And adjusted EPS landed at $1.70, up 17%.
Strong bottom line growth, too.
Now let's talk cash. Free cash flow. Reported as robust at $4.0 billion. That's a massive 104% increase year over year.
It is a staggering jump in liquidity, yeah. Speaks to significant operational discipline.
But let's be critical for a moment, for the listener. We know the company recently sold off a couple of Collins businesses.
Right, reactuation and flight control and the Simmons precision product businesses.
Did those sales artificially inflate that $4 billion free cash flow figure? Or is this mostly organic strength from operations?
That is the right question to ask.
Yeah.
And while the asset sales certainly help the overall balance sheet health, the $4.0 billion reported FCF figure is fundamentally driven by operational performance
Okay.
and working capital improvements. Things like inventory management getting paid faster, strong collections.
Oh, okay.
The fact that they maintained their full-year outlook, that $7.0 billion to $7.5 billion range, suggests they expect strong operational cash generation to continue separate from those one-off asset sales.
Right, that makes sense. And it makes the underlying demand seem even more impressive then. We saw double-digit growth almost everywhere. Commercial OE, commercial aftermarket, defense.
Yeah, all firing. And the global RPKs that measure for air traffic,
Right.
they're on track for about 5% growth this year. So
Yeah.
resilient passenger volume is definitely driving that commercial side.
And all this demand has created, well, a truly monumental backlog.
Monumental is the word. Total company backlog stands at $251 billion.
$250 billion.
Yeah, up 13% year over year, $148 billion commercial, $103 billion defense.
Yeah.
I mean, if that isn't job security for the next decade.
Ah, right.
But it also creates just immense pressure to actually deliver on it.
And the intake, the new orders, they're still accelerating faster than they can ship stuff out.
Absolutely. In Q3 alone, they bagged $37 billion in new awards. $23 billion of that was defense, $14 billion commercial.
$37 billion in one quarter.
Which gives you an overall book-to-bill ratio
Right.
of 1.63.
Okay, and for you, the listener, a ratio above 1 means they're bringing in this case, $1.63 in new business for every dollar of product they ship out. That's high growth mode defined right there.
And that outstanding performance, that demand, allowed them to confidently update their full-year guidance.
Right, they raised the adjusted sales outlook, now $86.5 billion to $87.8 billion.
And crucially, the organic sales growth forecast jumped significantly. It went from 6-7% all the way up to 8-9%.
8 to 9% organic. That confirms the operational performance is really dropping straight through to the top line.
Definitely.
And the earnings increase is substantial too. Adjusted EPS raised to $6.10, $6.20. And they were very specific here. The midpoint increase is driven primarily by about $0.20 of improved segment operating profit.
Exactly. That tells us this isn't some financial trick. It's the operational discipline paying off on the bottom line.
And it's vital to note how they achieved this growth, isn't it?
Absolutely.
Yeah.
They delivered 6 consecutive quarters of year-over-year adjusted segment margin expansion, while keeping the overall headcount flat across the organization.
Flat headcount with that kind of growth.
Yeah. That points directly to productivity gains. Automation, digital tools, process efficiency, you name it. They're literally doing more work with the same number of people.
So the overall financial picture looks stellar. We've established the money, the demand signals, but where is that growth actually coming from? Let's drill down into the engine and components story. Collins Aerospace and Pratt Whitney, starting with Collins.
Okay, Collins Aerospace. Q3 sales were up 11% organically. That indicates strength across all their major channels.
11%.
But the commercial aftermarket, the repair, maintenance, modifications for existing planes, that's the real engine here. Commercial aftermarket sales grew 13%.
Okay.
And that was fueled by mods and upgrades up 17% and parts and repair up 13%.
And that aftermarket strength is just so reliable, isn't it? Because of the sheer scale of the equipment already flying.
Exactly. Collins has over $100 billion of out-of-warranty content supporting this aftermarket.
Right.
That's just a huge, predictable revenue stream for years and years.
We also saw strong commercial original equipment sales, so parts for brand new aircraft, up 16%.
Right, up 16%. Largely driven by higher volume on narrow-body platforms, especially when you compare it to last year's Q3, which had that temporary hit from the Boeing work stoppage.
Right. That context is important. But it wasn't entirely smooth sailing for Collins, was it? They did note profit headwinds from an unfavorable commercial OE mix. Could you break down what unfavorable OE mix means for the listener?
Sure. Basically, when we say unfavorable OE mix, it means they're currently shipping a higher proportion of original equipment, those parts, for new planes.
Okay.
Those parts are typically sold at tighter margins, sort of as an initial investment for the airline. And conversely, they're shipping maybe fewer of the really high-margin spare parts and repairs needed for the older established fleet. So, yeah, they're making sales, but the type of sales they're making right now compresses margins a little bit.
Got it. And speaking of pressure, they also highlighted a pretty significant $90 million year-over-year headwind from higher tariffs.
Oof. Yeah, $90 million.
Is this like a persistent challenge, do you think, or a one-off hit they've now absorbed?
Well, that persistent tariff pressure, combined with that unfavorable OE mix, it really shows that even with record global demand, their margins are kind of fighting against these powerful external economic, even geopolitical forces.
Right.
It means they have to run their operations super efficiently just to stay ahead of these cost pressures.
Okay, now shifting over to Pratt Whitney, the engine division. Sales there were up 16% organically.
16%, led primarily by the commercial aftermarket again, which saw 23% growth. Huge aftermarket pull.
23%. And the major focus point there remains the GTF fleet management plan managing those existing fleet issues.
Yeah, and they confirmed it remains absolutely on track, both financially and technically. That's key.
And the ability to execute that plan hinges entirely on MRO output, right? Maintenance, repair, and overhaul.
Totally. And the PW100 MRO output was up 9% in Q3. It's up 21% year to date. They're aggressively targeting about 30% MRO output growth for the full year.
30% for the year. And that target is supported by what they called a record high number of Gate 3 starts. Now, for someone maybe unfamiliar with engine manufacturing, what exactly is a Gate 3 start?
Right, good question. So Gate 3 starts is basically the point in the MRO process where they begin the reassembly of a newly repaired engine.
Okay. The putting it back together phase.
Exactly. Achieving record numbers here means that the earlier, often more complex phases like disassembly, inspection, and crucially receiving the critical replacement parts, those are flowing much better than before.
Gotcha.
It allows them to finally ramp up the final output stage.
And to support this massive ramp up, the supply chain is finally showing some specific progress in critical materials, which they highlighted.
Yes, thankfully. They cited isothermal forgings. Those are the high-performance metal pieces needed for jet engine turbine blades.
Right, critical stuff.
Those saw a 16% increase year over year in receipts. And structural castings were up 29%.
Okay, those are concrete improvements.
These specific material flow improvements are absolutely essential because these are highly specialized high-tech components, limited suppliers globally. If you can't get the forgings for the turbine blades, well...
You can't build the engine. Doesn't matter how good your assembly line is.
Precisely. This is a direct measure of their hard work trying to stabilize the most stressed parts of that supply chain.
We also can't overlook the V2500 engine program, right, that powers the older generation jets.
No, definitely not. Despite seeing only a tiny, like 1.5% retirement rate of that fleet year to date, demand is still strong.
Why is that?
Because the average age of that V2500 fleet is still relatively young for aircraft, about 15 years.
Yeah.
That means there's significant aftermarket runway left. Lots of shop visits still to come.
Right. It's a testament to how long these aerospace assets actually last and earn revenue.
Absolutely. Okay, now let's pivot hard to the defense segments, because we see equally impressive demand signals there, particularly at Raytheon, driven by, well, global instability and the need for advanced deterrence.
Yeah, Raytheon's Q3 sales were up 10% organically, and the adjusted operating profit jumped 30% year over year. Big jump.
30% profit jump. And here is where that demand translates into truly massive defense contract.
Right, the order activity was just phenomenal.
It really was. We saw a $2.1 billion award for AMRAAM. That's the Advanced Medium Range Air-to-Air Missile.
$6.1 billion.
And they noted this is the largest single order in that program's entire 30-year history.
Wow, okay.
They also secured $2.5 billion for GEM-T to support international customers.
Okay, GEM-T, what exactly is that, and why is that international piece so valuable?
So, GEM-T stands for Guidance Enhanced Missile Tactical. It's a key upgrade for the Patriot missile defense system.
Ah, Patriot upgrades, got it.
And the international component is vital because generally, international defense sales are less subject to the year-to-year ups and downs of the U.S. government budget.
Right, more predictable.
Exactly. They provide highly predictable, long-term revenue streams, and often they come with pretty favorable margins, too. Oh, and they also secured a contract for Coyote production, focusing on counter-drone capabilities.
Counter-drone, yeah. That's obviously a rapidly growing area of defense spending.
Definitely. So these huge contracts drove Raytheon's backlog to a record $72 billion.
$72 billion just for Raytheon.
Yep. And 44% of that represents international business. But, you know, holding that record backlog is one thing.
Yeah.
Fulfilling it is another challenge entirely.
Exactly. That's the tension again.
Precisely. So to match that demand, capacity acceleration is a huge priority. And they're putting their cash to work, investing $300 million this year alone into capacity expansion.
$300 million this year.
Yeah. And a specific example they gave is the Redstone Missile Integration Facility. That's set to increase site capacity by 50% for naval programs, like the Standard Missile franchise.
Okay, 50% capacity increase at one site is significant. But $300 million in 1 year? Is that really enough to tackle a $72 billion backlog? Especially when they're also dealing with developing cutting-edge tech at the same time.
Well, it shows commitment, clearly, but they are definitely running hard to catch up. I mean, they highlighted the rapid product innovation, too, like the Stormbreaker ground launch demonstrator. Designed, developed, and tested in just 50 days.
50 days? That's incredibly fast.
And the AMRAAM team achieving the longest ever air-to-air shot from a 5th-gen fighter. These are amazing technical milestones, proof of engineering excellence.
But they increase the pressure on the production side, right?
Absolutely. And despite all that capacity investment, they are keenly aware of the major bottleneck. They explicitly stated it. Continued material receipts. Growth is necessary.
Especially where?
Particularly in critical value streams like microelectronics and rocket motors.
Ah, there it is again. Microelectronics and rocket motors.
This is the critical constraint right now. Defense production, especially complex missiles, relies heavily on those advanced microelectronics for guidance and specialized rocket motors for propulsion.
And those are items subject to intense regulatory hurdles, sourcing challenges.
Exactly. They just need those materials to flow faster to actually deliver on that monumental backlog and prevent it from becoming, a liability instead of an asset.
That whole supply chain puzzle brings us neatly to our final segment. Strategic priorities, financial management, how they're investing for the future while trying to keep the balance sheet healthy.
Right. On the innovation front, they're definitely positioning themselves for the next generation of aviation. Pratt Canada, for example, was selected for the EU's Clean Aviation Program.
What are you doing there?
Designing a hybrid electric propulsion demonstrator. It's expected to improve fuel efficiency by potentially 20%.
20%. So they're already looking ahead to where regulations and environmental demands are pushing the industry.
For sure. And Collins is doing similar things, focusing on extending product life. They're nearing final certification for a next-gen braking system for the A321XLR.
Okay.
Use a proprietary carbon technology, expected to significantly extend brake life which of course reduces maintenance costs for airlines. Big selling point.
Makes sense. But the strategy isn't just about physical products anymore, is it? It's about leveraging digital, leveraging scale.
Exactly. Using data analytics AI tools to improve productivity, directly addressing that constraint issue we keep talking about.
Yeah, the Raytheon AMRAAM team offers that perfect case study, doesn't it?
It really does. Using proprietary digital AI tools to proactively spot production bottlenecks, reduce rework on the assembly line.
And the result?
It directly contributed to their output, more than doubling year to date, without increasing headcount.
Doubling output, flat headcount. That's using technology to effectively manufacture capacity itself.
That's the goal. Now, in terms of capital allocation, they're continuing to strengthen the balance sheet while returning value to shareholders.
Right. They completed the sale of those two Collins businesses we mentioned earlier.
Yep. The actuation and flight control business
Yeah.
and the Simmons Precision Products business brought in about $765 million.
And they immediately put that liquidity to work, paying down debt.
Paid down $2.9 billion of debt just in Q3 and returned over $900 million to shareholders through dividends.
Almost $3 billion in debt reduction plus dividends. That absolutely demonstrates their commitment to that and not an or capital strategy they talk about.
Right. Investing aggressively in capacity and returning cash to shareholders, it's a balancing act.
And looking long term.
They reiterated their target, 90%, 100% free cash flow conversion over the long haul. They feel this is supported by strong business fundamentals, that huge backlog, resilient air traffic, the large installed bases in both Collins and Pratt. The operational foundation seems really solid.
Okay, so let's wrap up this deep dive for you listening. The key message seems to be that RTX is successfully capitalizing on just historic demand levels in both defense and commercial aerospace.
Definitely. And there are operational improvements. That core operating system, the AI tools they're deploying, the MRO RAM for engines, those are clearly translating into exceptional, profitable performance.
Which led them to raise their financial targets significantly for 2025.
Right. We've seen overwhelming demand, evidenced by that record $251 billion backlog, massive contract wins like that $2.1 billion AMRAAM order. It's impressive. However, the one persistent challenge the theme repeatedly highlighted across all the segments is that critical material flow and the overall health of the supply chain.
Specifically in those high-tech components.
Exactly. Forgings, microelectronics, rocket motors. That's the recurring headache.
So for you, the curious learner, the question we really want to leave you with is this. Given these accelerating production demands across both defense and commercial aerospace, how long will this decade-long acceleration in critical material receipts need to continue before the massive global supply chain fully catches up to production?
Yeah, ensuring that, and not an or, capital strategy, investing billions and paying out cash, remains sustainable in the years to come. When does the supply chain finally meet the demand signal?
It's the tension between the spreadsheets and the factory floor, isn't it?
It really is. And it's the powerful question that defines the next phase of growth for this entire sector. We encourage you to maybe explore the details of supply chain stabilization in high-tech manufacturing. It's fascinating stuff.
Absolutely. Thank you for diving deep with us today. We'll catch you on the next one.